So we're rounding up internal finance. We're rounding what internal finance is. It simply means sourcing for fund within the business. We have sales of assets, we have retained profit, and we have owner's capital. That's how we source for finance. So what are the advantages of using internal source of finance? Number one, the business won't be exposed to credit checks. No, that's the first one. Capital is available immediately. This source of finance doesn't need any approval from institutions or individuals for it to be used. Because it's an internal source of finance, the amount of money needed is already available. So you don't need third party. You don't need approval of anyone, approval of the bank manager or approval of the lenders before you can use the money. It's already available for you. So that's an advantage, which means you can simply use it at any point in time. Do you get the point? Yeah. Yes. The first advantage about using internal source of finance is that it's almost available for use. Unlike an external source of finance, you need to make a proposal, they need to approve it, and it takes time. But here, there's no waste of time. It's always going to be available. Now sit. It's always going to be available. Is it clear, please? The second one, it is cheaper. This simply means interest is not paid. As a result, cost is lower, profit is higher. Hello? I just stopped that already. The second point is about being cheap. Why is it cheap? It is cheap because you're not paying interest on it. It is your own money. It's the business money. Maybe you've sold an asset or retained profit, or the owner's business, or the owner's savings. So you're not paying interest on it. Because you're not paying interest on it, your cost of production is expected to fall. Therefore, you'll be making more profit. Because as soon as you pay interest on borrowed money or other sources of finance, you have to take it away from your cost of production. And it adds up to your cost of production. Then you have to take it away from your revenue. That means your profit will be reduced. But when you're not paying interest, which is an expenses, it allows you to have higher profit. Do we understand or not? Please focus here. Retained profits, because you're not paying interest, means your expenditures would reduce. Because if you are paying interest, probably through the external source of finance, you have to add it up to your expenditure. Then you have to deduct it from your profits. It reduces your profits. But here you're not, because there's no interest, that means your expenditure is reduced. It reduces your cost of production. Therefore, you are expected to make more profit. So, internal source of finance could increase the profit made by the business. That is the second point. The third one, the business won't be exposed to credit checks, unlike external source of finance, where lenders may have to check the credit worthiness of the business. No, banks will not want to lose their money. So before they could say yes to your loan, before they could approve your loan, they would have checked the credit worthiness of you. They would have checked if you have the credit worthiness or not. And how do they check that? They check if you are high risk or low risk. If you are high risk, it means you won't be able to pay back their loan as at when due. So they won't be able to give you a loan. But for internal source of finance, you don't need any credit check. It's your money. So nobody's going to ask you how you spend it. Do you understand the third point here? Do you understand, please? Yes. And the last one, there's no need to involve third parties, which means the affairs of the business is intact. Whatever happens within the business, it's yours. You don't involve anyone because it's not external source of finance. You want to source for finance, you use your retained profit. You are not answerable to anyone. You want to sell your assets, you are not answerable to anyone. Your savings, you want to put it into the business, you are not answerable to anyone. So whatever the affairs are, they are intact, they are internal. So you are not exposed to third party. Do you understand? So what are the problems about using internal source of finance? The first one, internal finance can be limited. Sometimes the amount of money available to a business through internal finance might not be sufficient to execute a project. It is retained profit. Retained profit cannot be as much as a loan you are taking from the bank. It's profit. After all, you take away your cost of production. So whatever amount of money left might not be enough for you to carry on or execute your project. It's retained profit. It's personal savings. Whatever amount of money you have, you can't have so much money like the banks. So the banks can give you double, triple of whatever you have in terms of retained profit or personal savings. So when you use any internal source of finance, the amount of money available to you or you have access to is limited. Do we get it or not? The first problem here is retained profit, sale of assets, personal savings. Whatever the amount of money they have, they are still limited. It's not going to be sufficient. It's not going to be enough when compared to external source of finance. Maybe the banks giving you money. The bank is a lending house, so they have a lot of money to give out, to make business out of. Do you understand? Your retained profit cannot be as much as the amount of money you use in starting up the business. Do you get it? The capital, the amount of money you use in starting up the business, the profit you make cannot be as much as that. Because you have to take that money away from the profit you make or the revenue you make. So whatever amount you make through internal source of finance, it is still limited compared to external source of finance. That's the first problem. Is it clear? The second one. Okay, the second one. Internal finance cannot be subtracted from the business for tax payable. So the point here is, because it's internal source of finance, either retained profits or sales of assets or personal savings, all these amounts are added up to the cost of sales. So you will get it as soon as you have paid your cost. What I'm saying is this: whatever internal source of finance you use, it would have been added up to make your profit. So it means you cannot separate it from the profit, and you cannot separate it from your cost of production. But if it is external source of finance, the interest you are paying can be calculated as your cost of production, which means you would have deducted it from your revenue before paying your tax. But for internal source, you would have paid tax before you have that amount of money available to you. Did you get the point or not? The point I'm making is this: for internal source of finance, you would only get it as soon as you pay tax. For external source of finance, you would have paid tax before you get it. We don't get it, right? For internal source of finance, it is a retained profit. For retained profit, you would have paid your tax before you get the retained profit, yes or no? So that means you cannot take away your cost of production from the retained profit, because it is part of your operations. Unlike external, the interest you pay on tax, the interest you pay on the loan that you got, is going to be taken away from your cost of production. It's going to be added to your cost of production, then you'll be making profit afterwards. But internal, you would have paid your taxes. Or for internal, it is part of your cost. So whatever that is left is what you take as retained profit. But for external, you would have added it up before taking your profits. Internal source of finance, profit is made, is a retained profit. You would have paid tax. For internal, you would have paid tax before you have the retained profit, because you cannot make profit without paying your tax. So your tax paid will be based on the profit you make. But the other one, you would have added it up to the cost before you have the amount available as profit. So that's why I wrote here. That's it. Unlike external source, which can be considered as part of the cost, therefore may be deducted from profit, which brings about lower taxes. If you are using external source of finance, your cost of production would have taken away the amount of money you have to pay. So your cost of production would have reduced the tax you want to pay. But for retained profit, because the profit is after tax, it might increase your cost and your profit will be less. External